The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
The consumer comes back to life, and so too does the stock market. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Remember yesterday's Fed drama?
No, I forgot all about it.
So did the market. All right, let's take a look, because the S&P 500 is at session highs, gaining for a second straight day, 0.6% advance, now up for a third time this week. And we see consumer durables and apparel companies getting a lot of strength after the better-than-expected retail sales report boosted sentiment. The dollar also rebounding from yesterday's decline, following reports that Trump is looking to fire Jay Powell sometime soon, which he later denied. And some relative calm in the Treasury market. The 30-year yield still above 5% right now, but certainly nowhere close to yesterday's 5.07%.
All right, back to the equity markets. Record highs for the Nasdaq, record highs for the S&P 500, better than estimated monthly retail sales, and the drop in weekly jobless claims providing another marker of economic resilience that underpins this grind higher that we're seeing in stocks. In fact, even when you strip out autos, the retail sales reading well ahead of expectations. A broad advance in consumer spending, allaying investor fears about tariffs, sapping consumer sentiment. Now, as far as market sentiment goes, that's getting a bit of a lift today, but that's actually coming, well, from positive earnings, particularly from economically sensitive companies like Pepsi, like Cintas, like Snap-on, plus the tech sector getting its own boost from Taiwan Semi, which raised its sales growth outlook by 10 percentage points to 30%, reinforcing expectations that Meta, Alphabet, and a lot of those other tech companies, they're going to keep spending to build out those data centers essential to AI. Now, the next big test for the market comes after the bell tonight. Netflix expected to report tonight a seventh straight quarter of double-digit percentage revenue growth, a metric more in focus now that the streaming video company is finally reaching beyond subscription fees and pushing deeper into advertising sales and live events as the levers of sales and profit growth.
The reason why Netflix started to get into the advertising game is that they capped out on subscriptions. And they're now not even reporting that as a metric, right? They're looking at revenue per user. So every single user, how are you going to monetize them? The easiest and most profitable way is through advertising.
And a pretty decent start to the earnings season so far. I know it's still very early, but can it get better, Scarlett?
Yeah, this is the question. Certainly, if you look at the S&P 500, people do think so. From a top-down perspective, better than expected earnings growth on the back of a resilient economy has really helped drive the S&P 500, the yellow line, higher over the duration. But according to Bloomberg Intelligence, fewer companies are sharing in this growth. Look at the white bars. They track the earnings breadth. That's the percentage of firms posting annual profit gains. So even as the S&P 500 was making new highs in the first quarter of this year, breadth fell to 66% in that period. That is down from 70% in the June quarter and well below the post-pandemic peak of 86% back in 2021. Now, historically, breadth has been a fairly reliable warning sign during equity market cycles. So you look at the first quarter of 2023, right around here, and breadth bottomed at about 56%, roughly aligning with the trough in S&P 500 earnings growth.
And that really puts a greater deal of importance on some of the earnings that we're going to get out of some of those big tech names. Ostensibly, that kicks off tonight with Netflix. Sarah Kunst joins us right now, Managing Director at Cleo Capital, as we count you down to those closing bells and count you down to Netflix earnings. Big tech, is that going to save us this quarter, Sarah?
I feel like it saves us every quarter, right? You know, I think that it's going to be a lot of bright spots here. Certainly the NVIDIAs of the world are already proving that. I love to watch Jensen work. That man kind of tap dances better than Gene Kelly, and we just saw him do that, pulling out a huge win around the concerns with China and the U.S. And so I think that we're going to see some of those names that are already pretty high continue to hold firm. I sent over my notes yesterday and I said Taiwan Semi. I had no idea what a great day they would be having today. And so that's awesome to see. That's a name that I always really like. And I think we're going to continue to see some love for, and it's pretty well priced. Yeah.
Well, can I stop you right there? Because I'm glad you brought up Taiwan Semi. And I think it's funny you use the analogy about Jensen Huang and his tap dancing skills there, because this does now become, at least when we talk about AI and chips, this does now become a little bit more of kind of a political dance, right, of how to sort of navigate trade barriers and the tit for tat going on between countries right now. You have confidence that while there is demand for AI spending, demand for data centers, you have confidence that the regulators, the legislators, and the politicians aren't going to get too much in the way of that trade?
I have confidence in Jensen. I'll be honest. I think that he has been navigating two governments that have not been friends for a long time, and he's navigated it incredibly well across multiple administrations. I don't think that's going to stop, and so I think that he is going to continue to figure that out for NVIDIA. Taiwan Semi is an interesting company because they'd already started to diversify that supply chain a little bit away from only China, only Taiwan. Because of some of the issues that they have separate from the sort of political problems with the US and China. And so, I think that they're in a really strong position too. I think these are very smart companies who are very, very used to navigating some of these more volatile governments in a way that a lot of the CEOs who are doing it now for the first time are maybe a little bit behind on.
Yeah, Jensen is a fascinating case study given that he's Taiwanese and he has the ear of leadership both in mainland China as well as in the U.S. I'm curious, though, in terms of this idea of personnel driving the company's fortunes. What about a company like ASML, which is really Europe's big chip maker? Yesterday, it came out with some outlook that really basically pulling its outlook that discouraged a lot of investors and set the Philadelphia Semiconductor Index lower. This idea, and they're just as exposed to AI in many ways as some of the other names. Why are certain companies coming out as not quite winners as opposed to just saying losers?
I think that it's hard right now if you're doing anything even slightly credible in AI to be a complete loser because the market still really likes it and it feels like one of the very few places that you can kind of get consistent possible growth. And so I'm not shocked that we're not seeing huge losers. I think some of these things are just overvalued. And when you look at the price, it's not even the CEO who's driving it up. It's not the company. It's just been the market looking for the next NVIDIA. And as they learn the kind of nuances and intricacies of these companies, this is not software. This is not consumer, right? And so it's much harder to just grow revenue and push a lever, launch a new product when you're actually making hardware or designing chips. I think as investors understand more about these companies, it's clear to them who really is in the lead right now and who maybe was a bit overvalued.
One thing I noticed, Sarah, is in the calendar, Alphabet will be reporting earnings relatively early for the Mag 7 names next Wednesday, whereas the bulk of them report the following week. Does that give it an advantage in any way? I mean, given that it is out front in terms of the kinds of companies we're paying attention to, how it's firing on all cylinders when it comes to new technology.
Yeah, I mean, I think that Alphabet deserves an advantage right now. It is wild to me, and I've been saying this for months, how relatively undervalued it is, given that everything the market wants right now, whether it's AI, social media, self-driving cars, Alphabet has that, and they have a steady, ability to build their ad revenue around AI in a way that a lot of their competitors don't. You're seeing when you Google more and more that there's an automatic sort of AI overview. They're figuring a lot of that stuff out, and so I think that they deserve that advantage. I don't think they're getting it, and I don't quite understand why. If it's sort of the C-suite storytelling that isn't really where it needs to be, or if the street is just missing a potential big opportunity.
I do have to ask you just about leadership overall. There's been a lot of talk about leadership in the tech space, obviously Tesla being number one, but also about Apple. I mean, a company that has been well run by any objective measure, but a lot of concerns about the idea that it might not necessarily be innovating. And do you need someone at the top who can maybe bring a little bit more, energy to picking new products? And I am curious as an investor, how you feel about that. Do you actually need that? Do you need that kind of inspirational leader, that big thinker? Or do you want, more of the staid, administrative type person who could just kind of, keep the lights on and the cash flow flowing?
I mean, if I had to pick between Apple and Tesla right now, that is a very easy choice. I'm going with Tim. I think that one of the problems that Apple's had is that they've tried to focus on sort of chasing these trends like AI. They're not a software company. They've never been a software company. They are a very good hardware company. And they also have a lot of employee loyalty. You're not seeing quite that sort of revolving door like you do in a lot of tech out of Apple right now, because I think people are pretty happy there with what they're building. I don't think they need to chase AI. I think they need to change the story around AI and say, yeah, you're going to be using your AI on our devices the same way you use everything else on our devices. So yes, you do need a leader who inspires confidence. And I think that's happened with Tim. I think he's making, it seems like over the last few months, some changes to things like the AI team that I think are better aligned with their core competencies. But I think that's more about not chasing hype and sort of sticking to what you're good at and just consistently delivering results.
All right. Sarah, I got to leave it there. Of course, we have to wait a few more weeks before we get to Apple on the 31st, but we get Netflix after the bell tonight. Sarah Kunst, Managing Director over at Cleo Capital, as we continue to count you down to the closing bells with a focus on former Treasury Secretary Larry Summers warning that the effort by Donald Trump to remove Jay Powell could actually spike inflation. A conversation up ahead with Nobel laureate Paul Krugman.
And of course, we're going to continue that conversation and talk about how ousting the Fed chief would dent investor confidence with Bruce Richards, CEO and chairman at Marathon Asset Management.
And of course, we continue to drumbeat to the results from Netflix after the bell tonight, a broad-based conversation covering all different angles, including the ad space, including the theme park space, Scarlett.
Yeah, Netflix is
something
playing a
you know
role.
about that? Netflix entering the theme park space. And we're going to talk anime, a surprising data out of Netflix just a couple of months ago saying that the majority of their viewers are watching the anime
And you're one of them.
content. I am. All that and more coming up a little bit later, right here on The Close.
You can't wait forever, because if we wait till inflation gets to 2%, well, then we've lost. We've likely injured the economy in some way that was completely unnecessary. And so I'm of the mind that, you know, the summary of economic projections we put out, which had 2 rate cuts for this year, I think that's a reasonable outlook to have.
And that was San Francisco Fed President Mary Daly in a sit-down conversation with our own Mike McKee at the Rocky Mountain Economic Summit at Teton Springs. Now, with the Fed's blackout period set to start this weekend before the FOMC's July policy meeting, let's bring in Mike now for context on Daly's remarks. Mike?
Well, Scarlett, the big question for everybody is, will anybody besides Chris Waller and Mickey Bowman vote for a July rate cut? Mary Daly suggested she is sympathetic to the idea of cutting rates soon, but she wouldn't go as far as to say that she is in on a July move. Probably September is more likely, but as you heard her say, 2 rate cuts this year still seems reasonable. She's worried if the Fed waits too long, the economy will slow too much. She noted that the labor market has weakened a little bit. We had slow job growth in the month of June. And so she wants to make sure that the economy doesn't go too far and the Fed get too far behind the curve. The other aspect of the conversation, of course, had to be what does she think of what the pressure that President Trump is putting on Jay Powell and the Fed. And she repeated the line you always hear from everybody at the Fed: we don't discuss politics. Our decisions are all based on what's best for the economy. It's obviously not helpful, but when we go in the room, we're just talking about the economy. I spoke with Randy Quarles, the former Fed vice chair, just a short time ago, and he said much the same. He also said that he didn't think so far the president has hurt the Fed's credibility, that if someone's nominated to be the next chair and they're seen as credible by Wall Street, then a lot of this will be in the rearview mirror. He also did praise, though, Jay Powell as a very intelligent and honorable man. Scarlett and Romaine?
All right, Michael McKee out there in Idaho. As we continue to focus in on the tit for tat between the president and, well, I guess himself, because, of course, Jay Powell has not responded to some of those concerns, but the market certainly has. Let's bring in Paul Krugman. He's a Nobel laureate in economics and a distinguished professor of economics at the City University of New York. And his Substack, a must-read, Krugman Works Out. Paul, I am curious about this idea of there not being any damage. I mean, even if Jay Powell isn't removed prior to his term, the idea that we've planted this seed, or at least the White House has planted this seed, that somehow he's incompetent, somehow that his policy choices have somehow been a mistake, and that we're going to right that, not necessarily through data, but simply by picking somebody that we think is ideologically aligned with the president's view, does that not in and of itself change the expectations in the market, and maybe not for the better?
I mean, sure. You know, what the Fed does in a given month, even what the Fed does between now and May, is a lot less important than what people think the Fed may do, you know, in the next few years. And so if we have a now quite strong possibility, even if we don't think that Trump will managed to or nerve himself up to fire Powell now, if we think that the Fed chair down the pike is going to be somebody, it's not even ideologically aligned with the White House, there's going to be somebody who basically takes his orders from the White House. I mean, that's a very different thing. It's one thing to have somebody who's hawkish or dovish or whatever, but what we really are looking at, I mean, I had a Substack, hawks, doves, and lapdogs. If we're going to have a Fed chair who is basically just taking instructions from President Trump, that's got to be really damaging to credibility.
It gets to this idea, though, too, of this idea of exactly where rates should be, and more importantly, what should be factored into the decision to move rates, whether it's up or down. And I know the Fed will tell you, look, we're just looking at the data here. But when you think about the fiscal dominance that seems to be emerging under this administration, I do wonder if the traditional metrics that we use to determine where rates maybe should go might actually be somewhat muted, given how much issuance is coming out of the Treasury, how much stimulus is coming out of Congress.
Well, what we do know is that Trump has a view of interest rates. Aside from he says that rates should be 300 basis points lower than they are now. And that's the kind of cut that you only do in the face of an economic emergency. But Trump says the economy is doing great, so he doesn't think that we actually have an emergency. He seems to think that the economy has been a good boy and deserves a rate cut. It's kind of like an achievement prize. And that bears no resemblance to any monetary philosophy that I've heard of. And yeah, fiscal dominance, the idea that I'm not sure that there is something he really wants, but I think a lot of it is just confused. But to the extent that there is something, there does seem to be growing pressure to de facto monetize budget deficits.
Yeah, well, as he put it,
catastrophic.
Yeah, he's given very different reasons for why he wants Jay Powell to go, from not cutting interest rates to not helping the government save money to spending too much money on the Fed headquarter renovations. Separate from the politics and this pressure campaign, does President Trump have a point in saying that the Fed funds rate is too high relative to inflation, relative to GDP, relative to the rest of the world?
No, I mean, if you were looking at the actual hard data, we have fairly low, more or less full employment. We have inflation slightly above the Fed's target, not a lot, but above the Fed's target. That would be a case for basically staying where you are. So any pronouncements about what the rate should do would be about what you think is going to happen next. And maybe the economy is going to slow down, although it's been pretty robust. We do know that at least headline, whatever Trump and people may say, headline inflation is going to rise at least for a while because of the tariffs. Now, we don't know whether that's going to be persistent or not, but surely, if you're thinking about the risks, at best, they're two-sided. There's nothing compelling in the data, nothing compelling, even what we know about the near future, that would say that you should be having significant rate cuts. I mean, I understand that if you think that inflation is going to continue to decline after some blip, then we might be cutting rates, but it's not there yet.
Well, how much of Fed reluctance to cut rates, to resume rate cuts, really, is tied to the fact that it got things wrong after COVID, insisting that inflation that we saw was transitory and then letting the economy run too hot for too long and not hiking rates sooner. And then when it did, it had to hike it by a lot.
Well, I mean, in general, the Fed is... Look, when people say the Fed got it wrong, I always want to say compared to who, right? Who were the people who really were? And yet you can find some people who gave better advice, but then you look and you find out that they gave bad advice on 10 other issues. And I don't think really, if you applied a Taylor rule or something like that to the current situation, it would say leave rates where they are or maybe increase them. Now, maybe we can make some judgment calls about that. But I think that a lot of what's happening is that I don't think the Fed is afraid of making the mistakes of 2021, 2022 again. I think the Fed is afraid that we may, we have an economy that is still running fairly hot by normal standards. We do not seem to be getting continuing disinflation the way we were through most of 2024. Again, where is the compelling case for a rate cut in all of that?
Professor, a little bit earlier today, former Fed Governor Kevin Warsh, one of the names that has been talked about as a potential replacement for Powell, he gave an interview on a competing network. And he talked about this idea of revisiting the Fed's framework, the idea that there needed to be sort of a new accord between the Treasury and the Fed, or the relationship between the Treasury and Fed, similar to what was done back in 1951, which actually gave the Fed greater independence. Now, he didn't really clarify if he wanted to do that in a way that would give the Treasury more control, but I am curious about your view of the interconnectedness between what the Fed does and what the Treasury does, and how those two should coexist.
Well, the reason that we have a tradition, it's really no more than that, but a tradition of Fed independence is that we generally don't. The trouble with monetary policy is it's too easy. It's so easy to just cut rates, and the temptation for a politician to cut rates for short-term political gain is just too large. So once upon a time we had the gold standard. There are lots of reasons why that was a bad idea, but an independent central bank in many ways serves the same purpose of not allowing politicians to play games with money for their own short-term political advantage. And can you tell me anything that would make that a less compelling argument now? I mean, even if you thought that maybe the president, a president might not be someone you worry about exerting undue influence, you probably wouldn't attach Donald Trump to that proposition. It's hard to think of anybody in U.S. political history who you would be more concerned about abusing political influence over the Fed. So no, I mean, Warsh is very vague about this, but that's actually kind of his hallmark. He says things that sound very impressive, and but to try to figure out what it was he actually said, that is kind of a Warsh thing.
Is there anyone out there that you would want to see in that seat? I mean, assuming that one way or the other Powell's gone by 2026, May of 2026, if it's not the names being bandied about, the Warshes, the Hassetts, Wallers, even Bessent, is there anyone out there that you look to and think this person would be perfect?
Oh, I think there's just lots of people. I mean, almost any. If you think it has to be a Wall Street guy, any reasonable Wall Street guy will do. I think, there's. We've actually had some pretty good academic economists in that role. Bernanke, Yellen, maybe we're not doing that anymore, but I don't, Fed government, we're not in times, there have been times when you really needed heroic leadership, when you needed a Bernanke or a Draghi. I don't think we're in that kind of time. We just need somebody sensible. And there's a long list of reasonable, sensible people. I don't have a particular preference, except that Waller would be I don't think Waller has a chance because he is a sensible, reasonable guy, and I think that's disqualifying from the point of view of the Trump administration. But everybody else on the list is kind of, I want to do the gesture because it is really, we're talking about the Fed becoming just an arm of the White House political operation.
Paul, as we end this conversation, you talk about reasonable and sensible. The president has resumed tariffs, or at least tariff threats, on different countries, including those who thought that they were making progress in bilateral trade talks. Your take is there really is no strategy from the president when it comes to tariffs. So what's the reasonable, sensible approach for those countries when they do negotiate? How do they do that?
Well, it's a really hard thing because the trouble is Trump is making demands for concessions when there's nothing to concede. European Union has a 1% tariff on U.S. manufactured goods entering the EU. What are they going to do? Cut that to zero? Is that going to make a difference? So the only strategy that might work is finding something meaningless but impressive sounding so that Trump can declare victory and pull out. And I have no expertise in how you do that. But this is really not about substance. This is all about trying to give the only thing that either you get confrontational, as the Chinese have, or you look for a way to make Trump feel good while not actually doing much.
So it's performative, and you allow him a way to save face, in other words. Paul Krugman, always appreciate your joining us today. Paul Krugman is Nobel laureate in economics, the distinguished professor of economics at the City University of New York, and of course, the author of the Substack Krugman Works Out. Coming up, we're going to be speaking to Bruce Richards. He's the CEO and chairman of Marathon Asset Management about his investment strategy, where he sees the outlook for public and private credit markets. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Boston.
And I'm Scarlett Fu. It took a solid retail sales report for everyone to, not think about the Fed and whether Jay Powell's going to be forced out.
Yeah, and well, sort of, right? I mean, like, we forgot about it for now until maybe the president brings it up himself. But it gets to this idea that the market continues to have to sort of navigate through potential shocks, if you will, or potential disruptions. And of course, all of this talk right now about the Fed chair and the Fed's independence, certainly something that I think the market would love to just look past.
Absolutely. And of course, the 30-year yield definitely reacted, as did the dollar. Our next guest says that the market has spoken. Leave the Fed independent. Joining us now to discuss is Bruce Richards. He is CEO and chairman of Marathon Asset Management. Bruce, always a pleasure to see you.
Hi, Scarlett.
What was your thinking when you heard the reports?
Well, exactly what you just said. I mean, you have to leave the Fed independent. Since the year 1913, 112 years ago, the Fed's always been independent. And the markets will not like lack of that. You have to have a line in the sand. You can never cross that line. The Fed needs to be vigilant also with respect to inflation. If the Fed's not independent, who knows where they'll bring rates down to, which could be inflationary. Bond market will not like that. And so while the Fed will control the front end Fed funds and bring that down to whatever rate you want to bring it down to, the longer will not respond well if we believe, and we all believe, that the Fed is no longer independent. So I believe that poly market's probably right, 25% probability that Trump will remove him. It's a low probability event relative to your base case. And I believe that he will not remove him because it's too much risk with respect to markets, and what he wants is lower funding costs. But in the same breath, I also know that rates are just simply too high. At 4.5% Fed funds rate, the ECB has rates at 2%, but at 4.5% Fed funds rate and inflation running at 2.5% CPI, PPI, and PCE, and no trace at all that tariffs really are impacting higher core good prices, because we've seen April, May, and June. We haven't seen it flow through yet. And so we have 3 months of that. And so we're seeing it at Marathon in the exporters absorbing it, the importers absorbing it, and very little actually being passed through. So I believe it's not hugely inflationary. And we can't wait forever, because GDP slowed from over 2% to 1.5% this year. Inflation's come down. And so with inflation at 2.5, GDP at 1.5, Fed funds should be 3%, not 4.5%. It's way too high, and I believe rates should be lower, but the Fed needs to be independent, full stop, and the Fed needs to be vigilant with respect to inflation.
And you're not the only one saying that. Jamie Dimon also said Fed independence is absolutely critical. I want to stay with Jamie Dimon for a moment, because during the JP Morgan earnings call, he made a comment saying that private credit has hit a peak when he was asked about whether JP Morgan might want to buy a private credit firm. I know that you have strong opinions on this.
Very strong opinions. I love Jamie Dimon. We all love Jamie Dimon. He does a great job. But look, at the end of the day, Jamie's talking his book. Of course, he wouldn't like to see as much capital being raised in private credit funds. In fact, he'd like to see a lot less by talking that game, so that way he can get back in the game and be a leader in private credit. And look, the banks are our partners. We have a great relationship with Webster Bank. They reported today great earnings. But with Webster Bank and Marathon together, we're originating and doing more and more deals, not less deals. Now, here's the big takeaway, though. Is private equity, Scarlett, Romain, going to be smaller or bigger 10 years from now? We all know private equity is going to be a lot bigger. If private equity is going to be a lot bigger, then direct lending is going to be a lot bigger. So we know it hasn't peaked, it's going to get a lot bigger. Number one. Number two, and this is really important, asset-based lending. We've been doing it at Marathon. This is our 5th vintage, and we've had extraordinary results. $30 billion of asset-based lending that we've done, but that's in its infancy of private credit relative to where it will be, and it will be as big as direct lending in the next 5 to 7 years. And then you have opportunistic credit strategies that are capital solutions that can also help private equity and companies. So when you look at it, the private credit markets are growing at 20% a year. I believe it grows to 10 to 15 trillion in a decade.
But here's
It's not peaked. Nowhere close.
And here's the thing, though. I mean, but just to that point, and I'm glad you brought up those numbers, because, and not to discount Jamie Dimon, but, I think what he says publicly and what's going on behind the scenes isn't always the same. And we've seen a lot of these big banks already sort of dabbling in private credit, in private loans. There's a story on the Bloomberg terminal today about how a lot more of these big banks are buying and selling private loans, kind of in a more informal capacity, but the idea that they're starting to make this more formal. And I do wonder if you think that the banks will finally have that sort of moment where they realize they can't keep poo-pooing this. They can't just sit on the sidelines, that they have to be an active participant.
I think there will be an active participant, but I think the markets, the public credit markets globally are around 12 trillion. The private credit markets globally are around 4 trillion. As markets converge, and a decade from now, as the economies grow and you have more debt, I think the public credit market will grow to about 15 trillion. Mm-hmm. I think the private credit market will grow to 15 trillion. Yeah. So I think banks will have a big say in this, but banks want to finance not the riskier deals that might be associated with LBO transactions and opportunistic credit deals and some of the ABL deals we're involved in, but they'll finance our debt and make a loan on our loans. And that's a very good place for them to play. Second thing, as we have the democratization of the wealth channels, and we develop that, you might want to have some secondary market activity in debt to allow for liquidity within some of these listed products. And so I like to see the banks develop, actually, some of the secondary markets, which they're thinking about developing today. I think that would be a healthy development.
I'm glad you brought up the wealth channel, because this seems to be the next big evolution for private capital overall, particularly with credit and equity. Today, Elizabeth Warren, the senator from Massachusetts, raised some issues about this democratization of the private credit space and the idea of whether it was potentially heaping too much risk on a level of consumer investor that maybe isn't as informed. And I am curious as to what you think about that whether we are maybe creating a situation where people who don't know what they're buying are going to end up buying.
So, do you think institutions and very wealthy individuals should be the only ones that benefit from the private markets? I can talk about the private credit markets, which have been generating an 11-12% net return with half the volatility of the equity market, when the equity market only generates a 7% historical return. So it's a better risk-adjusted return, I believe, in the private markets than you get in the public markets. And to deny individuals the opportunity to make those investments, to me, is so much regulation that you're wrapped out around it that you're actually hurting who you're trying to help. And so what's important are the banks. So think about JP Morgan and Citi Wealth and Wells Fargo and Bank of America and all these banks that have wealth management divisions. They vet all the managers and they make the recommendations. Or the RIAs around this country are making the recommendations after doing the research. Or the big platforms like a Case or like an iCapital are doing all the research to vet what's appropriate, what's not appropriate. And so, yes, they probably need a little assistance, but they have it there. Now, these are the same individuals who are day trading options on, on equities.
That's a good point.
And so to say they can do that and not have a better risk return profile associated with the half of the volatility of the equity market with a better risk adjusted return, to me, doesn't make sense, doesn't add up. But,
all right, Bruce, we have to leave it there. I wish we had more time, Bruce. Always love having you. Bruce Richards, CEO and chairman of Marathon Asset Management. And of course, as he speaks of maybe the risk-taking going on in this market, turn your eyes to crypto right now. You're seeing a lot of the names in that space like Coinbase and Marathon, unaffiliated, rally now to session highs as we learn that the House of Representatives have indeed passed one crypto bill, and it is the market structure bill that will now be sent to the Senate. Kayleigh Lyons joins us right now, co-host of Balance of Power. Kayleigh, what do we know?
Well, Romain, this is Crypto Week in the House of Representatives, living up to its name. The Clarity Act has indeed passed. As you mentioned, this is a market structure bill that divvies up jurisdiction over digital assets between the SEC and CFTC, slightly changed from the iteration we saw in the last Congress, the FIT 21 Act, that was attempting to do something similar. That act, FIT 21, only got 71 Democratic votes, which at the time was seen as robust bipartisan support. But important to note, Romain and Scarlett, that 78 Democrats voted yes for the Clarity Act. That is actually potentially something that could be seen as a mandate for the United States Senate, which would receive this legislation and have to grapple with the market structure question next. I spoke with Congressman Mike Flood, who sits on the Financial Services Committee earlier today, and he said if we get more than 70 votes, that's going to be a sign to Democrats in the Senate that they may need to get on board with this market structure effort as well. Now, of course, the United States Senate already passed the Genius Act, which would regulate stablecoins. That is what the House is actively voting on right now. And at this time, it does have the votes to pass as well. And that would be final passage of the bill. It would send it to the desk of President Trump, who could sign it into law as soon as tomorrow.
Okay, so that's two. There's one more bill that also is going to be worked on during this crypto week. What are the prospects for that one?
Yeah, that's the anti-CBDC legislation, and this is much of a thornier issue, as a lot of Republicans, specifically on the far-right conservative side, have great concern over the issuing of a central bank digital currency and want to prohibit the Fed from doing that. That is actually the thing that held up the procedural steps toward getting to the final passage votes today. Republicans were holding, or a handful of Republicans were holding up a vote on the so-called rule to move the process forward over the CBDC issue, and were promised by leadership that it could get tied into a defense appropriations bill by the end of the year. But that's another question that is going to be considered very differently in the Senate as well, considering you have to think about the different levels of Democratic support in that chamber. But it is going to be kind of a tandem effort. Conservatives did want to see that actually attached to the Genius Act, to the stablecoin legislation itself, but that was seen as being potentially a deal breaker in the Senate, which is why these have been broken up, or stayed broken up into many parts.
All right, Kayleigh, thank you so much. Kayleigh Lines joining us from Washington again. The House has enough votes to pass the stablecoin bill. The vote is ongoing right now, and this, of course, on the heels of the House passing the crypto market structure bill, which is now being sent to the Senate. We want to switch gears now and take a look at the broader economy, because this morning we got data showing that June retail sales handily beat analyst estimates and seeing a big upswing from the month of May. But our next guest says she saw at least one area of constrained spending. Let's bring in Dana Telsey, the founder and CEO of Telsey Advisory Group. Dana, tell us more. What area concerns you the most?
I think overall the areas that are of concern, definitely the weakness in department stores, what we've been seeing out of furniture, a little bit of electronics are the concerns. Certainly the theme of everything's good but seems to be holding, given the trajectory that we've been seeing, and everyone's waiting for when does the slowdown begin to occur. Back to school is right upon us now, and you're beginning to see all of the retailers put out their values in order to drive conversion sooner, because lower priced inventory is here now. We're going to get that higher priced inventory begin to creep in as we move through the month of August.
Are there retailers that you think are better positioned for the uncertainty, if you will, for lack of a better phrase, going forward?
What we've seen is those who are the haves. It's the discounters, it's the off-pricers, it's the brand leaders. Look at the strength you saw from Levi's last week with their strong sales. We have Ralph Lauren, who's driving strength, Tapestry with the Coach brand in particular driving strength. And then you've seen even, for example, like at the super high end, Brunello Cucinelli delivered a double-digit increase. But it's not everyone, because we still have weakness in department stores, you have weakness in some of the home areas, you have weakness in the department stores. So as we move through second quarter earnings season, we're going to see more telltale signs of what holiday will look like.
Dana, right now you say there's no evidence of across-the-board price increases, yet a lot of these retailers will need to start raising prices because their own expenses are going up, their own cost of goods are rising. Who can afford to do that? What will you be looking at in terms of the first movers on raising prices?
So we put out a price tracker every Tuesday. We've been doing it since the middle of April, pricing around 80 items, iconic items all across the board, whether it's Levi's 501s, Barbie dolls, you name it. And what we have seen so far is there's been some select items where there's been some increases. On average, it's around mid-single digits type of price increases. Retailers and brands have the ability to do a third, a third, a third. 1/3 basically is sharing the costs with the existing manufacturer. Other third is diversifying your sourcing. And the remaining third that companies certainly don't want to do is raising prices. What I'm looking for, who has the ability to raise prices, the most innovative and new items where there's better quality and make put into the product, where people say, I'm getting something new, that's where you'll be able to take a little bit of price. The essentials are where it's very difficult to raise prices because of the price comparisons that go on.
Do you anticipate that we are, given what you just said, maybe potentially some degree of discounting, some degree of a price war amongst those companies that don't fall into that top tier of having that pricing power?
I think you're going to see them manage their inventory carefully. I think you're going to see them promote. And yes, you are going to see some of the companies overall be aggressive in order to move goods, but also recognizing that, then what does this mean for their bottom line? the public companies overall are typically stronger than some of the private companies. So we're going to be watching closely.
Dana, always a pleasure. Dana Telsey, the founder and CEO of the Telsey Advisory Group. A closer look at those retail sales. And Scarlett, maybe a closer look up ahead of some of the earnings that we're going to get out of the retail and apparel makers. We're going to wait another 3 or 4 weeks before we get to them, but it could be very telling.
Yeah, it's all about managing inventory. It's all about managing their expenses while they try to wade through the fog of tariffs.
Yeah, absolutely. And this idea that we're not seeing it show up. It's not just that we had a strong retail sales report. Remember, we got an import price report that didn't show much increase in import prices, though we should point out the tariff dynamics are a little weird with that data because it doesn't actually reflect the tariffs that we paid after that import came in.
I wonder if it's going to be like Hemingway says, slowly and then suddenly all at once.
Yeah, possibly here. I mean, and it raises the question as to why you would actually be cutting rates right now until you have more clarity on that. All right, when we come back, we're going to get some clarity on Apple. The share is slightly higher on the day, but at least one analyst out there, he's got some concerns about their leadership. That's coming up next. This is Bloomberg. All right, time now for our top calls. Big movers on the back of analyst recommendations. And we start off today with Steve Madden. Citi upgrading to buy, boosting the price target to $32. The firm saying the shoemaker's margins bottoming as fashion trends become more favorable. The share is up 6% on the day, back to their levels from late May. Meanwhile, Mondelez. Jefferies upgrading the maker of Oreos and Ritz to buy, upping the price target to $78, with the analyst saying strong dynamics in Europe and potential relief from high cocoa prices actually bodes well for profit. Those shares up 3% to its highest level since October of last year. And finally, let's take a look at Apple. JP Morgan nudging its price target up to $250 from $230 and maintaining an overweight. The firm saying that they expect upside to estimates in the second half of the year from, quote, robust cloud spending. Now that you see the shares, they are up about 0.2% on the day, though this is the biggest laggard among big cap tech stocks on a year-to-date basis. In fact, Apple shares down 16% so far to start the year. Of course, that belies the 1,400% gain that we've seen in the share since Tim Cook took over as CEO back in 2011, more than a decade ago. And there are some folks saying that despite that stellar record, it might be time for a change. Walter Piecyk joins us right now, partner and TMT analyst over at Lightshed Partners. He had a great note out just about a week and a half ago, basically raising the prospect of maybe Apple does need a more product-focused CEO. I am curious, Walter, about the prospect, not so much of Tim Cook stepping aside, but like exactly who do you think could actually fill his shoes?
Yeah, I don't know who that is. That's the board's job to figure that out. There's certainly product-focused CEOs, hopefully that they've developed on the bench. That's what large mega companies do, right? They develop the next CEO because, God forbid, something happens that's unfortunate with the CEO. So theoretically, they should have already been developing someone on the bench. And that's really was the kind of the point of this note in the first place, when everyone was saying, like, don't worry with the COO leaving, that this is not going to disrupt the company, when they probably do need disruption. In your intro, you also mentioned the 1,400% return. In our note itself, we acknowledged what a great job Tim Cook had done for the company at this point in its history. That's what they needed at the time to get that iPhone to the next level and ramp and deal with all the logistics. But I'm a Philadelphia Eagles fan. We had Andy Reid. Andy Reid had a great run with the Eagles, and then he left. And the change was good. We have had 2 Super Bowls since, and I think the Chiefs have done okay with Andy Reid at a different company.
Yeah, absolutely. I like the analogy. I am curious, though, too, because this has been a conversation going on for a while, particularly when it comes to the product side. The idea that they've basically just been refreshing the iPhone and the Macs and everything else, but not really coming out with that new blockbuster. I know the Vision Pro was supposed to be that. But now there's this whole issue around AI and what Apple's strategy is with regard to that. And it seems investors are also frustrated that Apple hasn't done a better job at articulating what that future of AI looks like under the Apple umbrella. Do you have a vision of what you want that to look like?
I mean, I think first of all, great setup. Yeah, they over-articulated it last year at WWDC, where they over-promised what they thought they could deliver in terms of AI, and nothing has resulted. And we all now have the opportunity to use ChatGPT and Google and other voice attendants. And now we have agentic that's even getting to the next level for a lot of these companies. And then you go back to your iPhone and you try out Siri and you see the current state. So I think what's different this time, it's not about like, okay, Vision Pro was a flop and the speaker was a flop and things like that. and the $30 billion that they spend every year in R&D, and that's growing as a percent of revenue. It's not just about that. It's that we are entering the AI era, which will disrupt many large existing dominant companies. That's very exciting. That's very good for our economy, but it also is a tremendous risk. So it's more about not, hey, you haven't come up with something on this $30 billion R&D budget. It's what are you doing to defend yourself and then benefit from the opportunities that AI presents to the company.
You say overpromise and underdeliver, and in some ways that's kind of what happened with the original iPhone when they first put it out there. They had to scramble to make sure that they could deliver exactly what Steve Jobs had promised on stage. Why is it different when it comes to AI services or AI features on a device as opposed to a hardware product?
Because AI is moving so quickly. I mean, we see the advancements every week in the products that we can all use that are in front of us, and what we're hearing from enterprises. The cycles are moving much more quickly. You have well-financed competitors that are all entering this market, existing companies, as well as a lot of funds that are flowing into new entrants. So look, this is not the first we've written about this. We wrote about this last year and said, if we get to this point and they still don't have AI figured out, the probability of failure just continues to increase. So for those that want to extend Tim Cook yet another year, and I've heard that on some of these programs, fine, we can check back in a year. But a year from now, is it not going to be too late? Because it would have passed them by, and some competition would have had the opportunity to completely disintermediate what the iPhone means to consumers around the world.
So do they change their playbook and start going out and buying the talent like Mark Zuckerberg over at Meta has? I mean, Apple has, what, $133 billion in cash and marketable securities? They certainly have the firepower to do so.
I think they've already done that. They make small acquisitions all the time. They hire people all the time.
But a transformative acquisition.
So have they done transformative acquisitions? There's been apprehension in doing that. If we're talking about a board that apparently doesn't want to consider replacing the CEO, or is this a board that's willing to make a large acquisition? I mean, I think, you look at Perplexity or whatever, that they raise capital, and the market opportunity there is not that out of reach for a company like Apple. But the question is, does a company like Perplexity dramatically change things? Do they have the abilities to, get in and utilize the information that's in the phone greater than what Apple has already done on their own by spending more in a year, right, than what this company is being valued in the market today in terms of their R&D investment?
All right, Walter, really appreciate you taking time. And your note is really fascinating, too. And we should point out, I know the way these headlines get written, and they're very salacious here, but the research underlying that note, underlying that salacious headline, are really worth reading for those folks out there who can get their hands on it. Walter, have a great day. Walter Piecyk, partner and TMT analyst over at Lightshed Partners. Of course, Apple, one of the big laggards in the big tech space. And, of course, earnings for big tech, I guess we put Netflix in that category. That kicks off in just a few
Even though
minutes.
it's not a Mag 7 name, it's part of the original FANG or FAMGA group. But yeah, it's the traditional first mover when it comes to the tech companies reporting earnings. And of course, you have an S&P 500 already at record highs on anticipation that big tech will be driving that earnings growth. Yeah, and I would even say even more so now. I mean, we've kind of lumped them in as big tech, even though they're kind of always been a little bit of more of a media company. But now with this push into ad tech and some of the other new levers that they're trying to create here to keep the revenue growing here, certainly much more aligned with some of those big tech brethren than in the past. Well, speaking of other big tech names, you have the Philadelphia Semiconductor Index higher because of TSMC's raised full-year outlook. A full breakdown of all of today's market action and, of course, a breakdown of the results out of Netflix. That's going to start right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Scarlet Fu, taking you through to that closing bell with a global simulcast. It starts now. Tim Stenovic in the radio booth, Nora Melinda in today for Carol Masser, as we welcome our audiences across all of our Bloomberg platforms, Tim, including YouTube, on a day where all eyes are on the Fed, all eyes are on that economic data, Tim Stenovic, and all eyes are on some big earnings coming after the bell out of Interactive Brokers.
That's one of them. Netflix is another one. We're going to wait and see what we hear from Netflix in just a few minutes. But a real risk-on day where we could see a new record, depending on what happens in the next 2 minutes, on the S&P 500.
Yes, risk on day certainly, but we did see healthcare as the worst performing sector in the S&P 500. A little teaser for some of the decliners to come. Real estate is the second worst performing sector today as well.
And just a quick note as well that Congress is making progress on Crypto Week, right? We had the market structure bill get voted on and move on. So, they are moving forward with things. Bitcoin not getting much of help from this news. It's still down about 0.8%.
And this gets to the ideas. I mean, is this basically a risk on market? I mean, I know it's getting kind of a grind higher, but when you look at the day-to-day moves, Tim and Nora, I mean, it just seems that is the case.
Yeah, it really does. I was saying the tone of today's trade is so much different than yesterday, where everybody was so focused on what happens with Jay Powell. That's kind of in the rearview mirror at this point. You got Pepsi earnings, you got United earnings, driving things higher.
And I'm glad you brought up Pepsi, because that was quite the surprise, a pleasant surprise, but quite the surprise nonetheless.
Is it the poppy? Do you guys drink a lot of poppy?
No, too much fiber.
Okay.
Fiber?
Yes, all those little things.
We were debating Olipop versus Poppy
Don't get me started on that. So, yeah.
Strong opinions
all
on
right, let's move on here. Of course, we are setting up for those earnings out of Netflix, waiting for that to cross. As we see green across the screen with the Dow up more than 200 points, or about a 0.6%. The S&P 500 closing at a fresh record high, right around 6,297 and change, up about 0.5%. The Nasdaq Composite adds 153 points. The Nasdaq 100 adds more than 170 for a fresh record high for that index. And the Russell 2000, believe it or not, that's your outperformer, adding 27 points, or 1.2%.
All right, some optimism around those small caps. For those mega caps, though, and those large caps, the S&P 500 saw 373 stocks move higher, 127 stocks move lower.
And a pretty lopsided divide here in terms of the sector performances as well. 9 out of the 11 sectors finishing in the green. Financials and consumer staples leading the way, up 0.9%. Your laggard on the day is healthcare, down about 1.2%.
All right, well, very easy day for me to find stocks that moved higher. I want to start with the most actively traded stock today, Lucid Group, the electric vehicle maker, up 36%. They rose the most intraday ever. Investors learned that Uber is making a $300 million investment.
Now crossing the wire right now, Tim. My apologies here. 2Q EPS. We're going to start with the bottom line here. Coming in right now at $7.19 a share. That is a beat. The street on average was looking for $7.08. The company said operating income came in at $3.63 billion, and revenue on the top line $11.53 billion. So revenue rose, beat estimates. Profit rose, beat estimates. Gross margin, operating margin, expanded, widened in the most recent quarter. And here's your guidance for the full year. The company says that revenue will be in a range of $44.8 to $45.2 billion. That's above the guidance that it had previously given, above street estimates as well here. So it looks like a beat on the top and bottom line for the second quarter. The guidance for the third quarter and the guidance for the full year also coming in above expectations.
And it's worth noting here that in the statement, they say the revenue and operating income slightly above our guidance due primarily to FX, net of hedging, and the timing of expenses. So keep an eye on how companies play in fold in the dollar story, because the dollar's weakness, of course, in the last couple of months has really played a role here, especially for these multinational companies.
Stock up more than 40% going into this year, going into this report. It's pretty much doubled over the last year, adding about $250 billion in market cap. The company calling out in the second quarter Squid Game Season 3, Sirens, Ginny and Georgia Season 3, The Eternout, Secrets We Keep, in Tyler Perry's Straw, as well as Extraterrestrial, as hits that brought in viewers.
Hey, I just real quickly, I just want to go back to that revenue number for just 1 second, particularly with the guidance. I mean, they are making it clear in the press release that they have finally rolled out that ad tech platform. They did say that year over year, the revenue numbers that we saw for the quarter did include an increase in that ad spend or that ad take that they're getting. And they say that they expect that revenue from the ads business alone to double in 2025.
And remain talking about the ad business as we think about a lot of these competitors. Of course, we got that news earlier that Peacock's streaming service, Comcast, which is Peacock, their streaming service, they've raised the price for their ad tier service by $3. That's more than a 30% surge there. So it's going to be interesting to see how a lot of these companies shake out as we think about the streaming service more broadly here.
And you wonder with these big gains in the ad business, whether they're going to make a push to get more people onto the ad-supported tier, because it seems like at some point it's going to overtake the subscriber business, the subscription business, as the key moneymaker here.
You know, we spoke to an analyst from Wedbush earlier talking about, going into this. And what she mentioned is that Netflix actually had quite a bit of churn, but they have those customers coming back. Right. So it's succeeding when it comes to keeping those people paying for that content, whether it's live content, whether it's sports, whether it's those one-off events like a Tyson-Paul fight sort of thing. People, she said, are coming back for the content over and over again.
That's definitely what we heard through our interview with her. And it's really interesting, especially as you think about this being a space that's constantly evolving. We didn't expect sports and all these live events to be what people are coming back for, but you are really seeing them luring in these churners and actually getting them to pay a little bit more to get some of these opportunities and the content here.
And they talk about in the shareholder letter about leaning deeper into that live event space. Of course, they had the big MMA fight just last week. They have the Canelo Crawford fight coming up in the middle of September. And of course, that slate of NFL games that they have, including the Christmas Day doubleheader here. And that doesn't even get into some of the other things like the stand-up comedy and some of the other moves that they've made to kind of keep people in that ecosystem, not just coming in to binge watch the pre-made shows, to actually come in for those live events.
It's going to be interesting to see how they strategize what they do globally versus in the U.S. because even though they're so prominent in the United States, that growth prospect within the U.S. is really diminished, and the growth opportunity is really overseas. But the customers there, the viewers there, are not as profitable as the viewers in the United States.
I just want to remind everybody about how big Netflix has become. Remember, this is the company that invented sending DVDs by mail. It did the pivot to streaming. It saw that before anybody else saw that. It truly invented the category. Nowadays, on a market cap basis, it's bigger than Walt Disney, Comcast, and Warner Brothers Discovery combined.
Can I just go back to something that Scarlett just said, too, because it's a good point, this idea, too, of the push that they've made overseas. And I know you mentioned, Scarlett, it's not quite as profitable, but they do see that, at least on the top line of revenue, the idea that it is potentially a growth driver. They highlight that in the press release. They highlight some of the Spanish language content they've had, and particularly with The Gardener. Obviously, the huge hit coming out of Korea and Japan. And now, of course, the big deal that they made with France to actually have live news broadcast there from TF1.
Yeah.
As we were chatting earlier about some of these different contents that they have here, when we think about a lot of the shows, Squid Game is one that we have really been talking about. I'm looking at a BI note saying that management has really called out Netflix's second half of the year slate as, quote, a slight embarrassment of riches, given 3 of its most popular series will drop from late June through year end. So it's interesting to see some of their biggest products and what really gets people to come into Netflix to be called a slight embarrassment of riches here.
Okay, who's excited for Stranger Things versus Wednesday versus
Who's
Happy
not?
Gilmore 2?
Who's not?
Okay,
I'm
guys,
excited.
I'm not.
Stranger Things,
I'll be honest.
No way. I mean, that was a great show when the kids were cute
the first
and
2
cuddly.
seasons.
But, you know, now
enough.
do I want to see a bunch of 40-year-olds
Come on,
riding
guys. Come on.
around?
You want to see that? Just watch our show.
But I am Happy Gilmore too. I'm definitely all in on that. But have you guys seen K-pop Demon Hunters?
No. Should I add it to the watch list?
Yes. Now.
Romaine, you surprise us
stop.
sometimes.
Tim could do the rest of
I
the
thought you were
show.
going to sell it.
Okay, so you know what? You guys were spending some good time talking about the international and the opportunity for international. But here in the U.S., the question that I have is about what it does with growth slowing down here in the U.S. and how much pricing power Netflix has to keep raising prices and get more value from the customers that it has here in the U.S. now that new customer growth has slowed down.
See, I never thought that we'd actually be working with a Netflix that had ads. So it's so interesting how you see this evolution here. People are going from just wanting to watch it all the way through to actually being willing to pay for those little cuts in between.
Yeah, you extract more value from a saturated U.S. market by pushing people to the ad-supported tier. And that in turn drives up the advertising rates.
Okay, stop pushing. Because it's like what? So it was $6.99, then they moved it to $7.99 for ads. I mean, I'd be happily pay for something without ads.
I have to skip the ads. I'm sorry.
Premium customer over here.
Yeah,
that's going up too.
Premium.
Everything.
All right, we're going to keep continuing to cover Netflix earnings.
Get TV for free.
Remind everybody.
The rabbit ears.
Second quarter revenue coming in above estimates.
Sorry, Grandma. I almost got it.
All right, we got to go, guys. They're telling me it's time to go. That is going to do it for our cross-platform coverage of the market close of Netflix earnings. Don't worry, it's only Thursday. We're going to be back tomorrow, same time, same place.
We continue our coverage here on Bloomberg Television. A closer eye on those results that we just got out of Netflix. Those shares oscillating between gains and losses, now down about 2%. A big beat on the top and bottom line. Margins also did widen, though we did see cash flow on hand actually go down just a tad here. And the guidance going forward, I thought it was relatively encouraging. Let's ask Geetha Raghunathan what she thought of it. She's a Bloomberg intelligence analyst who covers this stock for us. Geetha, were you not impressed by what we saw?
I was pretty impressed, Romain. I think the big number that we were really looking for, of course, was the 2Q numbers, which all came in well above expectations. But I think investors are super focused on the revenue guide. And they did, as expected, they did raise the revenue guide. So it's up from 13%. They'd initially projected 13% growth for the full year. Now it's up to about 15%, $45 billion at the midpoint. And then again, operating margin also, they took it up a tad bit. But I think that might be a source of a little bit of a disappointment. I think a lot of people expecting over 30% operating margin guide, up from 29%. So that might be why the shares are oscillating a little bit. And then again, you have free cash flow. They raised that as well, a little bit modestly. But all in all, nothing to be disappointed about here.
Nothing to be disappointed about. But as you mentioned, that increased full year revenue forecast, which on the face of it looks incredible, the company did say it was mostly due to U.S. dollar depreciation. So it's kind of something that's out of its control. So to that extent, does it diminish what Netflix has managed to achieve here?
I don't think so. I mean, I think going into this quarter, as well as for the full year, we kind of expected some of these FX tailwinds to come in. Also, remember, this is the first full quarter, Scarlett, that they've had the price increases. So obviously, we're seeing that revenue momentum also build, and we're going to continue to keep seeing that through the year. The newsletter also mentioned something about, their ad product, and we've seen them kind of debut their Netflix ad suite, which is their own proprietary ad platform. So again, we're going to have to wait for the call to get some more color on how exactly their ad business is building out. But from all the initial signs, it looks like that is growing as well. So I think as far as all the catalysts and all the levers are concerned for the Netflix growth story, those are pretty much in place as of now.
What do you think, Geeta, of some of the changes, the physical changes that they've made to the look of the Netflix app, whether you're doing it on a mobile device or on your TV? The idea that it's supposed to make discoverability a little bit easier, which I would assume in turn would actually boost viewership and engagement.
Absolutely, Romain. I mean, this is where I think AI is really going to play such a huge role for Netflix. I mean, we've already seen, machine learning kind of really refine that algorithm in terms of, content recommendation, the UI, UX, the improvements that you just spoke about. Yes, we're seeing that. It was really evident in the Taylor versus Serrano match just a few days ago. So, yeah, I think, as we see Netflix, I mean, they've always kind of led in terms of product innovation. We're going to see them use AI even more deeply to enhance that. And all that does, it really kind of deepens their competitive moat. And it's really all about the virtuous cycle for Netflix. And we're going to see that, I think, play out nicely with all of these innovations and with the help of AI.
All right, good stuff. Geeta Ranganathan of Bloomberg Intelligence for giving us the instant analysis on Netflix's latest results. And as we were observing, Netflix shares kind of trying to find where they are right now, bouncing around a little bit here. You could see Netflix shares currently at the moment down more than 1%. Disney unchanged, a competitor certainly, and Warner Brothers Discovery just marginally higher by 0.4%. So those are some of the rivals here as we continue to keep an eye on the after-hours trade. For more on the price action of Netflix, let's bring in a Netflix bull, Danielle Shay, Vice President of Options at Simpler Trading. And Danielle, you're a Netflix bull, and this is a stock that does tend to move quite a bit on its results. But today we're not seeing a whole lot of that. How much of that is due to perhaps disappointment, as Geeta was telling us about, with that full year operating margin forecast?
Well, when I'm looking at this situation, I just feel like they beat, but they didn't have a massive beat. And so because the stock has already moved so much this year, I think that it's normal for it to digest and for it to have a little bit of a smaller movement after the bell. But what you have to look at is the expected move here was $77. And so that was about 6%. So if you look at the move that we're seeing, it's really not significant as far as a downside move.
And this, we should note, is a 7th straight quarter that Netflix has reported double-digit revenue growth, which is fairly incredible. The recovery it made from the post-pandemic lows after people started to go outside and no longer get new Netflix subscriptions. Talk a little bit here about the historical movement of Netflix shares following earnings results. I mean, for those who are counting on big moves, they generally were vindicated in putting that kind of bet on, weren't they?
Yes, that's correct. And when you look at the last 6 over 8 quarters, I mean, we've traded higher in Netflix. So it's been a pretty common trade to trade this ticker higher after the earnings report. But the thing is that these moves have been really big. We've seen 5, 6, 7% moves, upwards of almost 13%. And so, you just have to remember when you're looking at a stock like this that's already grown so much and has had these big moves, it's okay if it slows down a little bit, especially after it's just made this run into new highs. So I do continue to remain a Netflix bull. I'm looking for this stock to trade up into about $13.50 again, and then onwards and upwards into $1400.
Really? So I am curious, Danielle. I mean, when you look at particularly some of the trading patterns on the stock, and I'm just taking a look now, I mean, it's pretty much well above its long-term moving averages, including the exponential moving averages, still hugging the short-term moving averages here. Does that not give you pause, or is that more of a bullish signal?
It definitely gives me pause, however, because of the strength of the trend in this stock and particularly the relative strength in the overall market. That's why I continue to trade this name. This ticker has what I like to call a five-star pattern, where you have a combination of earnings, the trend, you have dip buyers coming in each time this stock pulls back, and it holds those moving averages really well on those pullbacks. We haven't had a bad earnings report in a while, and Netflix is pretty far out now from the writer's strike, the pandemic as well. And so it's just continued to recover really well. And for all of those reasons, I like it as a long-term buy and hold, but it's also a great trading candidate because it typically follows this trend really well.
I am curious about the broader impact on the market from Netflix. I know it doesn't have quite the same weight as Microsoft or Nvidia. I think it's like 3% of the Nasdaq and a little bit less, a lot less than that for the S&P. But from a psychological standpoint and an investor sentiment standpoint, do you think that this could actually help to lift the broader market?
Absolutely. Netflix earnings and then Tesla after that, those are, for me, the two most important companies that report every single season. I love trading tech. I'm big into the Magnificent Seven. And when Netflix has a positive report, that does increase the sentiment going into the rest of tech earnings. Now, today, it's a little bit lackluster, but guess what? It's not getting hammered either. So that will continue to help the Nasdaq hold at those new highs, and it'll give us some positive exuberance going into earnings next week.
Okay, that's a good point. What will you be watching for or listening for in the earnings call? I know that what you're doing is looking at a lot more technicals, but I'm curious whether the fundamental news, the headlines coming out of the earnings call, does tend to move the price, during that call.
Oh, absolutely. So when you're looking at the earnings call, I mean, first of all, I think we can all be happy with the fact that we don't really have to deal with tariffs, right? So there's that. But when you look at the earnings call, the most important thing is guidance and how excited the executives are for the future. I mean, I know for me as a Netflix user, the whole ad situation is a little irritating, right? But from a business standpoint, that is something that is going to help them continue to grow. They've been doing a great job with their original content. And I remember a few years ago, they were spending so much money on this, and this was a big concern for investors. But at this point, I think it's safe to say that it's been a very successful experiment. So I want to hear more about their original content that they have coming up, how excited they are about their ad spend, and what they're looking for the future.
Just real quickly, last question here, Danielle. When you look at what Netflix is and what it's become, do you at all, though, see any sort of value or any opportunity in any of its competitors, its major competitors?
Definitely. I mean, I think, first of all, you had mentioned earlier that they're the company that really started this whole streaming, right? Netflix and chill was not a thing 10 plus years ago. So, you have to look at that, and the other streaming services are important, but the thing is that Netflix is in the lead. Disney Plus is something that I was expecting to do a little bit better than it's done. So in this case, I would primarily focus on Netflix. Peacock, yes, has increased its value recently, but Netflix is the number one for me.
All right, Danielle, great stuff. Danielle Shay, Vice President of options, I should say, over at A Simpler Trading.
Yeah, Netflix is key and it's become a utility for so many people, but it's still lagging behind YouTube, which has a free service, right? I mean, you don't have to subscribe to YouTube or pay the premium. You can just check in anytime. You just have to pay for it with a lot of ads.
Yeah, I'm about to say, if you don't pay for it, the ads, oh my gosh. Let's hope Netflix doesn't go down that roll. And of course, in the past, we've heard a lot from Reed Hastings when he was helming the company about how he didn't really view Disney and Hulu and all those as the competitors. He viewed YouTube and gaming. And so like a Roblox is more of that. And of course, they've tried to address that, and we're going to talk a little bit more about that when we come back. But we do want to focus a little bit more on the ad business. Our wall-to-wall Netflix earnings coverage continues in just a second with Paul Verna, Vice President of Content at Emarketer. We're going to ask him about that new ad tech platform and just how far he thinks it can go. This is The Close on Bloomberg. Our special coverage of Netflix earnings continues with the share slightly lower in after hours trade. The streaming giant reporting 16% growth in revenue for the second quarter. And it says for the third quarter, it expects that number to bump up just slightly to 17%, driven, of course, by pricing, but also by advertising revenue. Paul Verna joins us right now, Vice President of Content at Emarketer, and that is the focus right now, Paul, on that ad business. Officially, I guess it started in 2022, but we really didn't see a real rollout of this until last year. The company saying in the statement today that at least that first phase has now been completed. It is seeing additions, additive to the top and bottom line for now, but the question is, how much, Paul?
Well, I think we expected the ad business to scale slowly. This is a very hard thing to build from scratch, as Netflix did. I think they stumbled out of the gate a little bit with overly aggressive pricing and a partnership with Microsoft that didn't really pan out. I think they've gone pretty far in figuring it out now, and they're very much on track. We're expecting them to hit $2 billion in revenue just in the US and then scale that up to about $3 billion within 2 years. So I think that's a pretty good start for them. Granted, it took a little bit longer to get here than maybe they would have liked.
As they build that out, and I mean, there's obviously been a lot of comparisons to how this ad business is going to stack up against, Peacock and Hulu, basically companies that are underpinned by basically ad businesses, legacy ad businesses. So they basically had not only just a head start, but a head start in terms of expertise. Do you think that, particularly given what we know about that Microsoft partnership and some of the travails with it, that Netflix has maybe found a better approach to how they're going to do this?
Absolutely. I think they have really started figuring it out and making it work for their business. It is not trivial in today's world that's so disrupted by AI and very sophisticated ad tech to just put something like this together and expect it to deliver results. I think you also have to consider that Netflix has been a subscription-only service for many, many years. They pioneered this space. So there's an association with that brand around ad-free. So they had to not only build a lot of technology, but they'd have to turn that big ship of a customer base that was already used to one thing, and they had to try to convince them to embrace another thing.
I'm looking through the news release, the letter to shareholders, and there aren't a lot of mentions of the word ads or advertisers, or certainly with numbers attached to them, right? They say they still expect to roughly double ads revenue in 2025. Why is it that Netflix doesn't dive deeply into giving numbers, providing numbers around its ad business? And when do you expect that to change?
Well, they famously stopped reporting subscriber numbers a few quarters ago, and that had been the metric that investors had looked at consistently for many, many years. They have since released some information about the ad business, both in terms of revenue and also in terms of how many of their users are on the ad tier. I think that data can be a bit dodgy or selective sometimes. But I think overall, if I were a Netflix investor, I wouldn't be concerned about the ad business not doing what it's supposed to do. It's just a slow build.
It's a slow build. Okay, and that's something that we'll continue to monitor. One thing that did change for the company is this deal with France's TF1. And a lot of people are saying that this could herald some changes for Netflix overall. Maybe it could be a platform unto itself. How are you thinking about what this opens up Netflix to?
I'm thinking that the TF1 deal is an experiment for what they might want to try to do in bigger markets, including the US, and that is delve into live TV programming. So that would become another in a long list of things that Netflix said it wouldn't do or wasn't interested in, like advertising, like live sports, like live events, and now live television, which is almost the antithesis of what Netflix's brand is all about. But you also have to consider that a lot of the cable networks that are held by the likes of Comcast and Disney and Warner Bros. Discovery, a lot of those they really amount to distressed properties now because they just don't have the audience anymore on the traditional TV side. So I think Netflix is in a position to maybe make some licensing deals or potentially even buy some networks outright and fold them into their entertainment offering with some mix of live TV and reruns or other programming.
All right, good stuff. Paul Verna, always a pleasure speaking with you. Vice President of Content at Emarketer. And again, Romain, that deal with TF1 in France allows members of Netflix in France to be able to access the linear channels and on-demand channels through their Netflix platforms. They don't ever have to leave that ecosystem. Well,
that's right. We're talking about an evolution of a company that is now basically not just a studio, not just a streaming platform, but now a broadcaster?
Yeah, perhaps.
Yeah.
I mean, you don't need a cable operator anymore, right?
Yeah, and we talk about just how far it's come over the years. Of course, you go back and it was just basically getting DVDs in the mail, and now, of course, it is just a full-fledged entertainment company.
All right. Well, today Disney is celebrating 70 years of Disney World. Speaking of companies that know how to do something with content, the CEO Bob Iger was there. He was ringing the opening bell. So up next, Romain, we're going to talk about experiences in theme parks.
Yeah, believe it or not, I mean, there is a direct connection here to Netflix, as Disney, of course, set the tone for what large-scale theme parks can be. Netflix trying to get in on the game itself. Len Testa going to be joining us, president of Touring Plans, when we come back after the break. This is The Close on Bloomberg. All right, let's take a look back in history to 70 years ago today and the opening of 20 amusement attractions on roughly 85 acres of orange and walnut groves out in Anaheim, California. Originally dubbed Mickey Mouse Park, it was officially christened as Disneyland. Now, it was not the first major theme park in the U.S. It wasn't even the first in California. In fact, that title belongs to Knott's Berry Farm, just about 7 miles north in Buena Park, California. But it was Disneyland that would set the standard for what a large-scale theme park could actually be, carving out a multi-decade path of transferring Walt Disney's massive intellectual property of characters from the silver screen to, well, everywhere, from stores to stage to the ice. The undertaking was not cheap, costing $17 million in 1955, or more than $2 billion when you adjust for inflation today. But the financial boon for Disney and for the city of Anaheim has far outstripped the expense. Competing entertainment conglomerates like Universal Studios took notice, as did niche toy companies like Lego, which followed with theme parks of their own. And now, 70 years after Disneyland debuted on this day, July 17th, 1955, Netflix is going to try its hand at theme parks too, sort of. Later this year, the streaming company is set to open 2 physical attractions called Netflix House, one in suburban Philadelphia and another in Dallas. It will be roughly about 100,000 square feet of retail space in each, with live entertainment, themed dining, experiential shopping, and of course storytelling centered around its original TV hits like Stranger Things. Now, 100,000 square feet is a fraction of the size of Disneyland, but Netflix has to start somewhere, and Netflix House is a step toward a more permanent presence on the ground for the DVD service turned Hollywood juggernaut. Though co-CEO Ted Sarandos, he bristles a little bit at the comparisons to Disneyland. He told investors on a conference call earlier this year that the exhibits at Netflix House would be changed frequently to create an experience that you would, quote, go to a couple times a month, not just once every couple of years. He says, think of it less like Disneyland and more like Topgolf. Scarlett?
And maybe the price tag will be more like Topgolf rather than Disneyland as well. Joining us now to discuss all of this is Len Testa. Len is president of Touring Plans, which helps customers plan their park and cruise trips. So he knows a lot about trips to Disneyland or Universal Studios. Do you think Netflix House is going to be something that your newsletter readers, the people that you cater to, will want to plan their trips around?
I think so. There's precedent for this. One of the things that Universal does really well is they have this thing called Halloween Horror Nights. every fall, where they set up houses, sort of like Netflix is doing. And there's typically 10 of them. They make so much money on that, I think it covers the park operating expenses for the entire year. Immensely popular. People plan entire trips about it. And the houses change every year, which sounds a lot like the Netflix model that we just talked about.
So Romain brought up IP and how this is really a play on IP to extend it, to allow visitors to engage and interact with the IP.
Right.
What do you think of the strength of Netflix's IP? Because Stranger Things is not along the same lines as, say, Mickey Mouse or any of the characters that have been around for decades.
I think that one of the things that is Netflix's strength is they are producing so much content that they could take something that hits this year, like this in the spring, and make it into a house in the fall. So they'd be able to capitalize very quickly on any hot properties that they have. And they've got so many things coming out that might be a strength for them, yeah.
What is the attraction right now to just theme park attractions? And particularly I'm talking about, the Walt Disney Worlds, the Universal Studios, those types of attractions. I know there's been a lot of staying power over the years, but is this still a primary destination for a lot of folks for vacations?
Oh, sure. Florida is the second most visited state for tourism behind New York. And that's true for both domestic and international travelers. The thing that keeps bringing people back is these theme parks, especially the larger ones, they're basically cities built for fun, right? So it's hard to go wrong with that.
It's hard to go wrong for that, though we should point out, at least when it comes to Disney World and Disneyland for that matter, it comes at a pretty hefty price. I mean, particularly if you're taking your whole family there, between the cost of admission, the hotels, and obviously the food and things like that. Is there room and space here for something that's maybe a little bit more affordable? And that's not a knock necessarily on Disney World. I know it's a sort of a special experience, but when you start to look at something a little bit smaller scale, like you talk about with the Halloween houses or with whatever Netflix is trying to do, I'm assuming that the value proposition there is going to be way different, way more cheaper than what you would get with a trip to Disney World.
It is, and it's really interesting that both Netflix and Universal are doing this. So later next month, Universal is opening a dedicated Halloween horror house in Las Vegas as part of a standalone thing. So this, and also they're opening one in Chicago as well. So this sort of regional, small, house-based entertainment complex is something that we're seeing a lot of in the industry right now.
How do you think about what Netflix is doing with the advertising that it is embarking on? Bringing in this new business and trying to scale that higher. Does it feel like this Netflix house is a way to engage people in its ecosystem, or is it more about driving people to spend more time on its platform and sell more advertising?
I think it's a symbiotic relationship. It's a circle. They can see which properties are doing really well and build houses around that, and then the houses reinforce the popularity of the content.
I am curious though too, because we were kind of talking about Disneyland and the 70 years, and I mean it's a great history because it really wasn't as much of a hit at the start as I think we look back on it now. It was a huge gamble, and I think about them picking that up, and then of course they had the success, and then of course they set up Disney World in Florida, and although I read that apparently it was originally going to be like in St. Louis or somewhere, but it was actually but there were some issues because they didn't want people drinking beer, which is St. Louis, come on. But it gets to the idea that, do you think that a large scale park along the size of Disneyland, where you're talking like hundreds of acres, could actually be open today and actually do well and be viable?
The capital investment would be massive, number one. Number two, you'd have to find a place that already isn't covered by other theme parks. So you'd be looking at like Texas, I think would be it. And that's where I think Netflix approach is probably very reasonable. Instead of outlaying billions of dollars for a full-size theme park, start small with a couple of houses and see where it goes from there. I think that's a very reasonable approach.
When you look at the theme park universe, you have Disney, you have Universal, you have the company behind Six Flags. But what if you're a smaller player, a smaller entity? How do you compete against those kinds of behemoths that have, such an established presence and are something that are on people's bucket list?
Right. So if you're like a Hershey Park in Pennsylvania, you're not going to be able to afford $500 million for one new ride. And you probably don't have the infrastructure around data and analytics and things like that. I think their key, and I think part of what Netflix is going to need to do here, is really engage with the local audiences. See what they want, offer them discounts, make sure that it's easy to get to and get out of so that you're not spending 2 hours in traffic. It's all of that sort of like, blocking and tackling fundamental stuff that is going to be the key to making those things a success.
So diving deeply into the local clientele.
Right. So one of the great things that Universal did when they opened up Epic Universe in May is it's really easy to get in and out of the park.
Yeah.
And basic stuff like that goes a long way with the locals who, that's your base for theme parks. The people in the areas, within a 40, 50-mile drive. If those people are happy, you have a good chance of success.
All right, Len, got to leave it there. Len Testa, who literally wrote the book on Disney World, the president of Touring Plans. Maybe one day he'll be writing a book on Netflix theme parks. Now, Netflix shares relatively unchanged as we wait for that conference call, that conference interview to start in just about less than 10 minutes' time. Meanwhile, keep an eye on Norfolk Southern. This is the railroad chain. They had rallied earlier in the cash session to their highest levels in about a year, now up about 5% in the after-hours trade after the Wall Street Journal is now reporting that Union Pacific is exploring a deal to buy Norfolk Southern. There was a lot of activity earlier in the morning between Norfolk Southern, CSX, and Union Pacific on speculation that Union Pacific was looking for an acquisition. The Journal now reporting, citing people familiar with the situation, that target is indeed Norfolk Southern.
Yeah, CSX shares also dropping after that Wall Street Journal report as well, we should mention. I wonder if these kinds of movements, along with Netflix's results, excuse me, sets us up for a day in which we extend today's rally. The S&P 500 gaining for a third time this week, record high.
Yeah, it'll be interesting to see what they say on this conference call. I call it a conference call, but it's really just one guy asking questions the whole time.
It's their version of a conference call.
But anyway, maybe that changes the sentiment there. But we talk about sort of the opening of the deals market, the IPO market, and that, of course, has an upside to investor sentiment.
This is The Close on Bloomberg.
Welcome back to The Close. Keeping an eye on Netflix as we await for that company's earnings conference call to start. The share is slightly lower in the after-hours trade, but the results were really good, and the company actually directly sort of links its strong results to its expansion overseas. That was in the release today. A press release that it put out just about a couple of weeks ago, it actually highlighted the idea of anime, saying that more than 50% of its global subscribers are watching the genre, a genre that is, believe it or not, relatively new to the Netflix platform. Roland Kelts joins us right now. He's author of the best-selling book, Japan, America, and a visiting professor at Waseda University, and an expert on Japanese culture and, more importantly, the export of that culture around the world. And Roland, I think anyone who's turned on Netflix and just gone through the offerings, even if you're not an anime fan, you'd be remiss not to notice just how much content from the anime universe is now on the Netflix platform. And I am curious as to what you think is driving that. Is that a concerted effort by the studios in Japan to get this content out? Is that Netflix pulling the content itself, or is this organically coming from the viewers themselves?
I would say the last two. It's Netflix pulling the material out of Japan and coaxing the studios into deals, and it's an organic explosion of fandom around the world. Anime has this unique global appeal. The characters travel very, very well. And I think Netflix has 33 different languages now that they dub anime. And so, if you're talking about Pokemon and you're watching it in India, it's your Pokemon. It's an Indian Pokemon. If you're watching Pokemon in Indiana, it's your Pokemon. Pokemon's American all of a sudden. So anime travels very well. The characters are what Japanese call mokuseki, which means nationless, stateless characters. And that's part of the appeal. There's also just so many genres of anime. It's astonishing. Hundreds of series produced every year.
It is astonishing, and I like this idea of it being kind of stateless, and the idea that you could kind of take basically that animation and with the right dubbing sort of translate it for any market in a way that's going to be palatable for the local sensibilities. But of course, not every anime that comes out is a hit. I mean, there have been a lot of duds that they've put out, and I'm curious as to what you think separates sort of the ones that do sort of enter the cultural zeitgeist globally and the ones that just kind of fade away.
Well, they do. The studios produce, in many ways, too much anime. It's on television all the time here in Japan. And as you point out, a lot of series are duds. There's a system, a production system here, which is where production committees invest very, very little money into the projects so that if they have a big hit, the profits are enormous. What makes a show a big hit? Usually it's great storytelling. People who don't know anime, especially if they're not from Japan, they tend to focus on the visuals, the spiky hair and the lively action, etc. But usually what makes a story stick is the narrative itself. And I think one of the reasons anime is becoming so popular, especially with Gen Z, younger viewers, is that the Japanese style of storytelling is so different from the Hollywood 3-act structure. And these episodes, they have cliffhangers, they go on, they probe deeper psychological realms. You know, Pokemon is up to, I think, over 1,000 pocket monsters.
Yeah.
So you can grow the universe, and Japan has for years practiced something called the media mix, which just means transmedia. So you go from a manga series. You know, most anime are adapted from manga series. So if you have a very popular manga comic book series, and you turn that into an anime, and then you get the T-shirts from Uniqlo, and then you get the costumes that you can wear to an anime expo, you can just explode the universe.
Yeah, I know, Roland. I mean, Scarlett and I were just talking before the show about Uzumaki, which just came to Netflix earlier this year. That was a manga from like the 80s. It finally got on. It's a little dark, Scarlett, but
reviving some old IP, right?
Yeah.
Okay, so I guess the question here is, you mentioned that Pokemon in India and Pokemon in Indianapolis could be your own version of Pokemon because it was dubbed. Talk about the economics of sub versus dub, right? Subtitles versus dubbing. The dubbing, as you made clear, allows people to engage with the content and you know, develop a tie with the content in a way that subtitles don't. But the subtitles allow the viewers to understand the way that the anime should have been produced for the first time, right? How it should sound, how the characters do relate to each other. I'm just curious about the economics of that as anime becomes more popular to viewers all around the world.
That's an excellent question, because it's a long-standing debate in the anime fan community. You know, voice acting in Japan is a very, very serious and celebrity-oriented business. And this stems from the post-war period when you know, John Wayne was overdubbed in Japanese, and the Japanese actor who played John Wayne became famous, maybe more famous than John Wayne. So voice acting is very, very critical in Japan, and the voice actors themselves become superstars, celebrities. However, and so voice acting can be quite expensive in Japanese, the original Japanese. Dubbing is much, arguably less expensive because actors in Canada or other parts of the world don't make as much money. However, subtitling is appealing to a certain fan base because, as you just said, they want to hear the original Japanese. And some fans say the Japanese acting is so much better than the English language or Hindi language acting. But it's an interesting question, because I've asked several directors and artists here in Japan how they feel about it. And quite a few artists, anime artists, prefer dubbing because then the viewer can appreciate all the work they've put into the art. You know, if you're watching subtitles and reading across the bottom of the screen, you're missing some of the magical visual artwork that the guys and boys and girls worked so hard to create. So I've had anime directors say to me, "Oh, I can't stand subtitles because I hate to watch the audience staring at the bottom of the screen when all of the work I put into the visuals is getting missed."
Roland Kelts, thank you so much, giving us his take on this eternal debate, author of the best-selling book Japan America and visiting professor at Waseda University. Did you watch that anime series?
I did.
Dubbed or with subtitles?
No, we had the subtitles on it. So, so yeah, and it was cool. But he was right, though. I mean, the visuals in that, it's a lot going on, and if you are just reading the lines at the bottom, you are missing a lot.
All right, still ahead, Netflix's earnings call is currently underway. We're going to parse through all the latest. You look at Netflix's shares moving down about 1%. Not a pretty big move given what it's done in the past.
Yeah, absolutely. We'll be back in a moment. This is The Close on Bloomberg.
Netflix reported earnings this afternoon, and the earnings call is currently underway. The company telling investors that they see healthy member growth and no major impact from economic uncertainty. Chris Palmieri of Bloomberg News, who covers media and entertainment in Los Angeles, joins us now. So, Chris, looking at the headlines that have crossed, what gets your attention?
Well, it looks like they're trying to reassure folks. They did increase their forecast for the profit margins for the year a little bit, and some people were suggesting maybe this is just due to a bump they're getting from foreign currency. So much of their business is overseas now. Looks like they're trying to reassure folks that they're going to continue investing in that TVs and movies programming, premium stuff, and they're still going to grow their profits. That their fundamental business is pretty sound.
They also say here that their content expenses will ramp in Q3, Q4. I mean, we were talking a little bit earlier on the program about the big slate of content, a very ambitious slate, and one that likely could potentially lead to an increase in viewership. What's the balance between that new slate, Chris, and the amount of money they have to spend on it?
Well, it's interesting because if you're looking for a downside in the numbers today, they did say overall viewership was only up 1% in the first half, which is sort of nothing compared to the double-digit, revenue and profit numbers they're showing. So, and they said, well, that's just because a lot of this content that we're producing is coming in the second half. So that's going to be the test. If all this programming they're talking about, boxing matches, NFL games at Christmas, movies, big expensive series, all of that really translates into a growth in viewership.
Romain and I were talking about how in the past, Reed Hastings had talked about the competition of Netflix being sleep, being gaming. In the past, they've also talked about YouTube being a competitor, and we've seen YouTube's market share increase, whereas Netflix's has stayed fairly stagnant. Is Netflix's goal to overtake YouTube? Is that a reasonable goal?
Yes, that's always what they've said is, their competition isn't Disney or HBO or that. One of the big picture themes here, though, is, and we just saw this today with Peacock raising the price of its service $3 a month, almost 40%, is that the market is getting less competitive. All of these guys are trying to wring more profits out of their streaming services, which, in some cases have been money losers for quite a while. And so Netflix doesn't feel the pressure to cut, its price or in any way, economize there. I mean, it is raising prices as well, and that's a big part of what it's doing. And these ad sales, which they said would double this year, this is a revenue opportunity that's driving the profit growth.
All right, and a record quarter for the company. Chris Palmieri, our man out there in Los Angeles, as we, of course, focus in on Netflix, the new big Hollywood studio out there. Let's push ahead to what could potentially move the market over the next 24 hours. That includes several earnings, including from American Express, 3M, Charles Schwab, and Huntington Bank.
And in fact, we're going to have a conversation with the CEO of Huntington Bank at 3:30 p.m. right here on The Close.
We're also going to get some economic data starting at 8:30 a.m. Eastern time.
Yeah, housing starts and building permits certainly key, especially as mortgage rates stay relatively high.
And we're also going to get a read on sentiment, the UMich sentiment numbers out at 10 a.m. And then I think this is interesting. The Treasury Secretary on a visit to Japan. Presumably this is about the trade deal or some sort of trade deal.
That hasn't happened yet. Yeah. They keep promising that it's around the corner. I mean, it's been going on for months now, or weeks at least.
Yeah, well,
feels like months.
Maybe we'll see if Roland Kelts can meet with him and talk to him about the anime economy.
Yeah.
All right, that does it for us. Please tune in tomorrow for The Close and for your politics coverage. Stick around. Balance of Power is up next on Bloomberg.